What if money isn't actually scarce at all? What if the constant pressure you feel working more, earning more, saving more, yet somehow falling further behind is not a personal failure, but a designed outcome? From childhood, we are taught that money is limited, that resources are tight, and that competition is inevitable. But here is the mystery no one asks loudly enough: if money can be created instantly by banks, if governments can summon trillions during emergencies, and if debt appears out of thin air with a signature, why does scarcity dominate your daily life? This contradiction is the doorway into what can only be described as the financial matrix's system that feels natural, unavoidable, and permanent, yet is built on assumptions that collapse the moment you examine them closely. The deeper you look, the more unsettling the realization becomes. Scarcity is not a law of nature. It is a narrative, and narratives can be engineered. To understand how we got here, we have to go back to a time when money was simple. For most of human history, money was tangible and limited by physical reality. Gold had to be mined. Silver had to be weighed. If you wanted more money, you had to produce something of value. Scarcity was real because nature imposed it. No one could create wealth with a pen stroke, but power always seeks leverage. Early rulers learned that controlling money meant controlling armies, trade, and loyalty. The first cracks appeared when kings began debasing coins, reducing their precious metal content while keeping the same face value. People still trusted the symbol, even as its substance was quietly reduced. This was one of the earliest lessons in financial illusion. Perception matters more than reality. Banks took this idea further. Goldsmiths noticed that depositors rarely withdrew all their gold at once, so they issued more paper claims than gold they actually held. Fractional reserve banking was born not through conspiracy, but convenience. It worked as long as trust held. And trust, once institutionalized, becomes invisible. As banking systems formalized, governments realized debt was more useful than taxes. Taxes provoke resistance. Debt creates dependence. By borrowing from banks, states could spend today and promise payment tomorrow, binding future generations to obligations they never agreed to. Scarcity became embedded into the structure itself. Not because resources were lacking, but because repayment demanded perpetual growth. The real turning point came when money fully detached from physical limits. When currencies abandoned gold backing, money stopped being something you earned from nature and became something issued by authority. From that moment on, scarcity was no longer natural. It was managed. Here's where the financial matrix truly locks in. Modern money is created primarily through debt. When banks issue loans, they don't transfer existing money. They create new money and charge interest on it. The principal is created, the interest is not. This mathematical gap guarantees competition, default, and inequality over time. Someone must lose for the system to function. This is not accidental. It is structural. As economies expanded, this debt-based system fueled growth, innovation, and rising living standards at first. But growth became a requirement, not a benefit. If growth slowed, defaults spread. If defaults spread, banks failed. Banks failed, governments intervened. Each crisis justified more control, more complexity, and more distance between money and the people who used it. The breaking point didn't arrive suddenly. It arrived quietly, through signals most people ignored. Wages stopped keeping up with productivity. Asset prices rose faster than incomes. Housing shifted from shelter to speculation. Education became debt-funded. Healthcare became financialized. People worked longer hours, not to get ahead, but to stay in place. Then came the crises. Every major financial collapse followed the same pattern. Easy money, inflated bubbles. Warnings were ignored. When the system cracked, the damage flowed downward. Ordinary people lost jobs, homes, and savings. Institutions were rescued. Each time, the explanation was the same. The system was too complex, too important, too interconnected to fail. But notice what never changed. After every collapse, the system was fixed in ways that preserved its core logic. Regulations multiplied. Central banks gained more power. Money creation accelerated. Scarcity for the public intensified, while abundance for the financial sector expanded. The paradox deepened during emergencies. During crises, governments suddenly found unlimited money. Trillions appeared overnight. The myth of scarcity vanished temporarily. And then once stability returned, the story snapped back into place. Austerity, budget limits, tightening discipline. The message was clear. Abundance exists, but not for you. This is how false scarcity sustains itself. It is not enforced through violence, but through belief. People accept debt as normal, inflation as inevitable, housing as unaffordable, work as endless. The matrix doesn't need guards when the rules feel natural. Now, look around today. Digital money. Central bank balance sheets, larger than entire economies. Young generations, priced out of ownership, while concentrating at levels unseen in a century. The patterns repeat with stunning consistency. The system produces inequality, then explains it as personal failure. It produces instability, then calls it a cycle. Produces dependence, then labels it responsibility. Even proposed solutions often reinforce the same structure. Lower interest rates encourage more debt. Higher rates protect currencies but crush workers. Universal programs funded by debt still rely on centralized control. Technological fixes promise efficiency, but rarely question who controls the system's code. Escaping the financial matrix doesn't mean rejecting money or markets. It means understanding the illusion at the center. Scarcity is real in nature, but artificial in finance. When money can be created infinitely, but must be repaid by finite human labor, imbalance is inevitable. So what does this leave us with? First, understand that money is a system, not a fact of nature. Systems can be redesigned. When you see money as a set of rules instead of a moral scorecard, guilt and shame lose their grip. Second, recognize patterns, not promises. Whenever a solution requires more debt, more centralization, and more complexity, ask who benefits first and who pays last. The answer is usually consistent. Third, reclaim agency through literacy. The most powerful threat to the financial matrix is understanding, not rebellion, not collapse. Awareness. When people see the system clearly, it loses its ability to disguise control as inevitability. Here's the warning. Systems built on illusion don't collapse when exposed, they adapt. The next version of the matrix may be digital, automated, and invisible. Convenience will replace consent. Efficiency will replace choice, and scarcity will remain unless questioned. The open question is this. Now that you can see the code, will you continue to live inside it unconsciously, or start making decisions with clarity instead of fear? If this changed the way you see money, history, or power, share it. Subscribe for deeper breakdowns of the systems shaping your life. And remember, escaping the financial matrix doesn't start with wealth. It starts with understanding.